The Fed chairman just testified before Congress and promised to defeat inflation. The money supply just hit a record $23.1 trillion, or one of those two things is a lie. And gold already knows which one. What if everything Wall Street told you about money was a carefully constructed illusion? What if the numbers that make gold and silver prices look alarming today are actually the most rational, historically grounded figures you have ever encountered? What if the single greatest wealth transfer of the modern era is unfolding right now, in slow motion, in plain sight, and most people are completely, catastrophically blind to it? Stay right here, because in the next few minutes, something is going to click for you that will never unclick again. There's a ratio that has served as the financial world's most honest compass for 2 centuries. It requires no algorithm, no Wall Street analyst, no Bloomberg terminal. You simply take the Dow Jones Industrial Average and divide it by the price of 1 ounce of gold. That number, that single, elegant, unforgiving number, tells you how many ounces of gold it takes to purchase 1 unit of the American stock market. And right now, that ratio sits at approximately 12 ounces of gold to buy the Dow. It sounds reasonable until you understand what history says should happen next. In 1999, at the peak of the dot-com mania, that ratio reached 43 ounces of gold for 1 unit of the Dow. Paper was king, gold was the fool's errand. And then came the reckoning. By 1980, during the stagflation decade that burned a generation of investors, that ratio had compressed all the way down to roughly 1. A single ounce of gold was worth virtually 1 entire unit of the Dow Jones Industrial Average. The stock market, measured in real money, had been gutted. Gold, measured in stock market units, had become the equivalent of the entire index. In January 1980, gold peaked at around $850 per ounce, while the Dow sat at roughly the same level, bringing the ratio to nearly 1.1. Every peak in paper has been repriced in gold, every single time. Now consider where we are today. The US M2 money supply surged $248 billion in May 2026 alone, reaching a record $23.1 trillion, the largest single monthly jump since May 2021. That is not a rounding error. That is not a seasonal adjustment. That is the largest expansion of liquid American money in 5 years, and the 5-month total for January through May of 2026 reached nearly $700 billion. The last time money supply accelerated at this pace, the inflation that followed devastated household budgets for years. And here is the part they never put in the headlines. Inflation does not arrive immediately. Based on historical patterns, the bigger impact from money supply growth could appear 6 to 18 months later, with the strongest consumer price effects potentially showing up in late 2026 and into 2027. The grocery store does not feel it first. Asset markets do, within 3 to 9 months. Gold knows, silver knows. The calendar is already running. Hold on. Do not go anywhere yet. Because what we are about to show you about the Federal Reserve's role in all of this, and what they are not saying while they pretend to fight inflation, is the most important thing you will hear all week. You need to hear part 2. This is the architecture of a moment that history will record as one of the great turning points in monetary affairs. Gold surged 66% in 2025, its best annual gain since 1979, while silver skyrocketed 142%. And yet, and this is where critical thinking separates the informed from the crowd, those gains were followed by a sharp pullback. Silver soared from $47 to its first ever break above $100 per ounce, ultimately reaching $116 during January 2026 before pulling back. As of late May, gold and silver stood at $4,163 and $74 per ounce respectively, double-digit declines from those January highs. The crowd sees a failed rally. The historically literate see a retracement within a multi-decade secular bull market. Exactly the kind of gut-wrenching pause that shakes out the impatient before the next leg up begins. The case for dramatically higher gold and silver prices does not rest on speculation or wishful thinking. It rests on the brutal arithmetic of a sovereign debt burden that has made the Volcker solution, the 1980 strategy of raising interest rates to 15% and crushing inflation through financial pain, mathematically impossible. In 1980, America's debt-to-GDP ratio hovered around 30%. Today, it exceeds 120%. The Federal Reserve's balance sheet currently stands at $6.7 trillion. The interest payments alone on the national debt now consume a staggering portion of federal revenue. The Fed cannot raise rates the way Volcker did without triggering a sovereign debt crisis that would make 2008 look like a warm-up act. Inflation, therefore, is not just the path of least resistance. It is the only path available. And the metals understand this with a clarity that no Federal Reserve press conference will ever publicly acknowledge. What is the alternative to managing debt through inflation? There is none that a democratic government can politically survive. This is not cynicism. This is history operating on schedule. You are still watching Good. Because what follows is the part that institutional investors are only now beginning to whisper about in rooms most people never enter, and you're about to hear it clearly. Stop what you're doing and pay very close attention, because the next few minutes contain information that the financial media has systematically failed to connect for its audience. The dots are all visible. They simply require someone willing to draw the line between them. The man now presiding over American monetary policy is Federal Reserve Chairman Kevin Warsh. By institutional standards, he is a hawk. He arrived with the declared intention of fighting inflation and restoring price stability. He testified before Congress this very week. The nation's annual inflation rate fell to 3.5% in June from 4.2% in May, and on a monthly basis, prices actually fell by 0.4%, the first one-month price decline in 6 years. Yet Warsh told the House Financial Services Committee, "It's one data point. There might be some that look at this morning's data and say, 'Oh, mission accomplished.'" He refused to declare victory. He is, in the vocabulary of central banking, talking. Talking about fighting inflation is the preferred substitute for actually eliminating the conditions that create it. Warsh himself has said, "I think money, strangely enough, has something to do with monetary policy. It has been absent from the discussion." This is a remarkable admission from a sitting Fed chairman. For decades, the Federal Reserve paid little serious attention to the money supply itself, focusing instead on interest rates and inflation targets while the M2 aggregate ballooned without remark. Now, for the first time in years, the money supply has reappeared in the Fed's official semi-annual report to Congress. The monetarists, the school of thought that traced inflation directly to money creation, have been largely vindicated by the inflation of 2021 and 2022. And the M2 data of 2026 suggests the experiment is being repeated. Inflation has been above the Federal Reserve's 2% target for 5 consecutive years. Think about what that sentence means. For half a decade, the purchasing power of American savings has been systematically eroded beyond what the central bank itself considers acceptable. Recent inflation indicators posted multi-year highs, with the Consumer Price Index for May indicating a 4.2% annual rate. And yet, the Fed funds rate remains where it is, because the alternative, a serious rate increase, would accelerate the cost of servicing a $36 trillion national debt to levels that would break the federal budget. This is the trap. This is the corner into which decades of fiscal excess have painted American monetary policy. The only tools that remain are the ones that erode the real value of money, and gold and silver are the only assets that have historically preserved value through precisely this kind of monetary erosion. If you have been on the fence about whether to subscribe to this channel, if you have been watching for weeks, learning, building your own understanding of what is happening in the metals market, now is the moment to click that button. Hit subscribe right now, because the information flowing through this channel in the months ahead, as these forces accelerate, is the kind you will want to have been receiving from the beginning. The community here sees what is coming. Join it before the next leg up makes everyone else wish they had. Now, here's the dimension of this story that virtually no mainstream financial outlet covers with any seriousness: the global recollateralization of the financial system. The world's central banks, the institutions that determine what qualifies as a reserve asset, what counts as sound collateral for the global monetary architecture, have made a consequential decision. They are moving out of U.S. Treasury bonds and into gold, not as a gesture, not as a symbolic diversification, as a structural multi-year reallocation of sovereign reserves. Goldman Sachs estimates that central bank gold purchases are now averaging around 60 tons per month, far above the pre-2022 average of 17 tons, with emerging market central banks continuing to shift reserves into gold. That is more than triple the historical rate of institutional gold accumulation. These are not retail investors chasing momentum. These are the sovereign treasuries of nations deciding, at the highest levels of economic strategy, that gold is more trustworthy than American paper. The implications of that decision, compounded over years, are not subtle. Consider the scale of what is potentially in motion. The global bond market represents approximately $140 trillion in assets. The entire global gold market, all the gold that trades in ETFs, futures contracts, and physical form, represents roughly $14 trillion. If even 10% of global bond holdings rotates into gold, it represents a flow of capital equal to the entire existing gold market. Price discovery under those conditions would be nothing short of extraordinary. Analysts at BNP Paribas predict both gold and silver will reach new all-time highs in the not-too-distant future, potentially this year, noting that the factors driving the 2025 rally remain structurally intact. This is the part where the numbers become almost impossible to say with a straight face. But they are grounded in data, in history, and in the undeviating logic of capital markets. Prepare yourself. You have watched this far for a reason. Your instincts about the financial system are correct. What comes next is the confirmation, presented not as a prediction, but as a historically documented possibility that deserves serious consideration by anyone who cares about protecting what they have built. The Dow to gold ratio currently sits at approximately 13, even with gold near record highs. Every peak in paper has been repriced in gold. The math of a return to historical norms is not comfortable for anyone who has parked their wealth entirely in paper assets. If the Dow were to correct by 50%, a scenario well within historical precedent during major bear markets, and the ratio were to compress to 1.1, as it did in 1980, the resulting implied gold price at a $26,000 Dow would be $26,000 per ounce. At the current Dow level, a 1.1 ratio implies a gold price in excess of $50,000. These figures are not predictions. They are illustrations of what the ratio has done before, applied to current numbers. The ratio touched 1.1 in 1980. It touched 1.94.1 during the Great Depression. These are not theoretical events. They happened. They happened because paper promises eventually encounter the gravity of reality. JP Morgan currently targets $6,300 gold by year-end 2026, while Bank of America projects silver between $135 and $309 per ounce. Goldman Sachs has raised its December 2026 gold forecast to $5,400. These are not fringe figures. These are the largest financial institutions on earth, putting their reputational capital behind price targets that would have sounded extraordinary 5 years ago. The crowd has not arrived yet. The retail investor has not pivoted en masse. Investors have been taking profits and moving into equities, creating space for re-entry into the precious metal space, but it would likely require a major macro event to reignite interest. The conditions for that macro event: accelerating money supply, persistent inflation, geopolitical dislocation, and a sovereign debt trap, are not hypothetical. They are the present reality, documented in Federal Reserve reports and Treasury data. Now consider the valuation gap between the metals ecosystem and the technology sector. Silver skyrocketed 150% in 2025, outperforming even gold's record-breaking surge, driven by its central role in semiconductors, batteries, and the AI industrial complex. Silver's conductivity makes it irreplaceable in the physical infrastructure of artificial intelligence. The data centers, the chips, the solar arrays that power the computation, and yet the entire listed global mining sector, the companies that extract these metals from the earth, remains valued at less than the market capitalization of a single consumer electronics company. The commodity supercycle, a recurring historical phenomenon in which capital rotates out of financial assets and into real, tangible goods, does not announce itself with a press release. It arrives when the valuation absurdity becomes undeniable. Silver's industrial applications represent something upwards of 60% of annual demand, making it simultaneously a monetary metal and an essential industrial input, a dual identity that no other asset on Earth possesses. The same ounce of silver that hedges against monetary debasement also goes into the semiconductors that run the AI economy. Kevin Warsh can speak about artificial intelligence's disinflationary potential all he likes. The physical silver required to build the infrastructure for that AI revolution has to come from somewhere. And the deficit between what the mining industry produces and what the world consumes has been running negative for years. Gold is still up 36% over the past 12 months, and silver has climbed 133% over that same period. The pullback from January highs has shaken sentiment. This channel has watched sentiment indicators reach what appear to be historic lows in the precious metals community. That is not a warning sign. That is a buying opportunity. Bull markets do not end when nobody wants in. They end when everyone is already in. And right now, by every measurable metric, almost nobody is in. Both gold and silver enjoyed record-smashing rallies in 2025, surging 66% and 135% respectively. While the rally continued into early 2026, trade soon turned volatile, exactly the kind of volatility that defines consolidation phases within secular uptrends, not the end of those uptrends. The world is repricing collateral. Central banks are buying gold at triple their historical rate. M2 money supply just posted its largest monthly expansion in 5 years. The Fed chairman is testifying before Congress about fighting inflation, while the structural conditions that cause inflation remain completely intact. The global mining sector is valued at less than one technology company, and the ratio between the Dow and gold, the honest two-century measure of paper versus real money, sits at 12, a full decade above where it has historically bottomed. The question before every person watching this channel is not whether these forces are real. The data confirms that they are. The question is whether you are positioned before the crowd arrives or after. If this analysis has sharpened your thinking, if it has connected dots that the financial media has left scattered, then leave a comment below. Tell us where you are in your journey. Tell us what you own and why you own it. Tell us what questions you still have. This community exists for exactly that exchange. for the kind of conversation that the mainstream financial press is structurally incapable of having. Your comment is not just appreciated, it is part of what makes this channel worth building. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk.